Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, this show gets you actionable insight on everything personal finance related. And as part of this program, we also speak to the people that manage your money, mutual funds. And today, I have my first guest, who is the CIO of PGIM India Mutual Fund, Vinay Paharia. And I think it's an important time to be speaking to you. Vinay, thanks so much, first of all, for taking the time, and pleasure speaking with you. Let me first ask you how you're analyzing all of the moving parts, and there are so many, more than usual now. And there's so much noise, so much more, again, than usual. What are you focusing on right now?
Hi, Alex. Thanks for having me on your show. So I think, Alex, as you rightly mentioned, there is too much of noise. There is too much of macro level developments, and there would be too many first order, second order, and third order effects of what we are seeing right now in the macro. Because traditionally, whatever we have been taught, we have experienced in the last 30, 40 years is now getting upended and changing. In this scenario, I think the way to approach this is, Alex, not get too much perturbed about what is happening right now and make changes by panic reacting, but to look at the big picture, to look at what is likely to happen over a longer period of time, because developments in the short term can at times be very, very perplexing and can result in decisions which are suboptimal. So I would encourage investors to slightly elevate their horizon, to zoom out, and then make decisions which are going to have a longer range impact. As of now, based on what we are seeing, the developments around us, they're too much chaotic, and we do not think that we will have the current level of macro uncertainty persisting. Something has to change in the next 3 to 6 months, and we think that things will start getting normalized after that.
There is often, I like to say this, I'm not the first one to say it, I'm pretty sure, but like in physics, like in life and in markets, there is often a reversion to the mean that eventually takes place, and equilibrium is sought, equilibrium is often found. And so to that end, I wanted to talk to you also about what has occurred in the Indian equity markets over the last three years, where, and barring the last 6 months, of course, where you had a kind of a reversion of mean take place, where momentum really drove so many stocks, so many pockets of the market into effervescent valuations or crazy valuations, and that is being reversed. I've seen you describe this as odd. Why is that?
Sure. So, Alex, when we look at investments, we generally do not look at it purely from a qualitative perspective. We try to analyze fundamentals from a very long-term perspective, analyze what has worked in investing, and practice an investment philosophy which is evidence-backed. So when we are doing this, we analyzed historically what has worked for investing in India for more than 2 decades now. And what we found is very startling. We found that if you have invested in a diversified portfolio of high quality and high growth companies, you would have outperformed the underlying universe 2 out of 3 times. And the magnitude of outperformance is also significant. So the simple corollary is that create a portfolio of good quality and high growth companies, and you should do well. However, as you have rightfully highlighted, in the fiscal year 2024, that is from 1st April 2023 to 31st March of 2024 period, we saw the exact reverse happen. We saw companies which were low quality and low growth in their nature significantly outperform the high growth and high quality companies. And the magnitude of outperformance is what was unprecedented. And this is what we thought has to change. And I think since June of 2024, the market has started to normalize again, and we have started seeing some bit of correction in this anomaly. So for example, if the magnitude of anomaly which we saw in fiscal year 24 was 100, we have already seen a reversal which will claw back that 100 to at least 70, 60 to 70%. So I think the markets are normalizing fast. The poison is completely not yet out, but we are quite hopeful that over a period of time, the high growth, high quality companies will definitely say outperform the rest of the universe significantly. And that's not just back testing, that's also quite logical. And I think there is financial theory backing all of this, and hence we think and we are quite optimistic that this kind of an approach will work for investors over a longer period of time.
Okay, so the purpose of this conversation also is to help your investors and prospective investors understand how you're viewing things and how you're building your own portfolio. So very quickly, if you can take me through that thesis, and obviously well known that you have a growth and a quality bent when you're selecting your stocks. But then you've also gone out and spoken about certain factors that you utilize to further sift these companies as well. So very quickly, tell me the thesis that you have and your own underlying expectations for the current financial year and the next, just so people have a sense of how to benchmark their own expectations.
So the way we analyze stock selection companies for selecting stocks is fairly straightforward, Alex. We do not just look at historical returns on equity. We look at future returns on equity and the potential for making future returns on equity. Classic case in point is a lot of these new age companies which might be making low ROE or maybe making losses today, but in future due to operating leverage are expected to make significantly higher returns on equity. So our focus is look at the forward quality and look at the forward growth in the underlying gross profit of companies. So we look at what could be the next 5-year potential returns on equity and next 5-year growth in gross profit. And based on that, we create a universe of companies. And then based on our fair value method, we try to identify which of these companies can potentially deliver superior returns based on their discount to their current fair values. So for example, if a company's fair value is 100 today, and if it is trading at, let's say, 90, then there is this potential 10% gap which it can bridge in the next 5 years and can provide a return which is slightly higher than the growth in the underlying fair values, and vice versa. So our job is to look at what is the price to value today and what is the potential return an investment can offer over the next 5 years, and compare the entire universe based on this approach and try to optimize the portfolio return based on the potential expected return going forward. And since this is very live, this is based on changes in market prices on an ongoing basis, this takes into account a lot of developments, changes, etc., and hence it's quite flexible.
Okay, and also, so the second part of that was also to help my viewers understand how your own estimations are for earnings and therefore for expectation of returns in the relatively near term. I'm talking about FY26 and also heading into FY27.
So I think, Alex, when you look at the markets today and the macro environment we are in today, it is akin to an economic COVID-like situation. You and I can keep discussing and debating about what can happen next, but none of us know what the virus is doing. None of us know what the strategy is going to be adopted on tariffs. So at this point of time, all of us are trying to adapt to a situation which we are being thrown into. We think that this will normalize over a period of time, and hence one should not panic for the simple reason that that productivity, quality, etc., all play a very important role in trade. And I think over a period of time, just as markets are weighing machines over a longer period of time, but short term they are voting machines, similarly, trade cannot be suppressed by artificial tariffs for long. And I think that is bound to happen over a period of time. And hence, coming to your question, what is likely to happen over the next 6 months or let's say 1 year, it's very difficult to predict the course of earnings and the course of markets in the next 1 year. But if you were to think about the likely outcome over the next 3 years or next 5 years, I think what becomes more and more clear is that India as an economy is likely to grow at the fastest pace on a relative basis as well. India as an economy is having the least exposure to global economy, and hence any such disturbances are going to create challenges for India, but they are going to create much more challenges for other economies. So on a relative basis, India is likely to do much better. And because of that, companies operating within India are also going to see on a relative basis much superior growth in their fair values. And as we see over the next 5 years or 3 years, this fair value will translate into underlying growth in market values. And hence, we think because of the correction in valuations, gradually the drag on potential returns versus fair value growth has started shrinking. Remember, we started with a significantly higher than fair value situation, which meant on a forward basis, we would have borrowed some of the returns from the future. But now we are starting to once again postpone some of that returns into the future, so that over the next 3 to 5 years, our returns will now gradually start coming very close to the fair value growth. And remember, if you are able to create a portfolio of reasonably high growth and high quality companies, the fair value growth can be slightly higher than the nominal GDP growth rate. And hence, the overall return expectation for an investor should start coming closer to that.
Okay, yeah, and interesting. So just to drive home that point, we're talking about the RBI just made a projection for 6.5% growth for the current financial year. Inflation projection is at 4%, and so therefore you're talking about nominal GDP growth of anywhere between 10 to 10.5%. You're talking about maybe 2 percentage points more than that is a standard expectation for equities. So bear that in mind. Correct me if I'm wrong, Vinay.
Broadly, I think that's what you are referring to. But yeah, I think the only delta is that 2%, because of the number of companies which have started to emerge in India in the last 5 years, which are taking advantage of growth, that 2% has started to go up.
Sure.
So I think the opportunities have improved.
Okay, so it could well be better than that, but I guess to benchmark your expectations, that should be good enough. The last point that I have is, have you made any material shifts in the orientation of your equity portfolio to take into account everything that is happening? Are you, for example, and I know that you have not a necessarily very large sectoral allocation in your, I've looked at your FlexiCap fund. I only have data based on February end because that's the fact sheet that you have available, but you have a 19% allocation to banks. IT is about 9% odd. Given everything that is shifted though in the recent weeks, have you made changes to your portfolio allocation?
Yeah, so in the previous month, we would have reduced our allocation to IT, largely anticipating some challenges in the US economy. Remember, the noise related to tariffs was already there. And what we thought is that irrespective of who gets impacted or not impacted, if there are tariffs which are going to be erected on all the countries, then the one single conclusion which you can derive from that is that the American consumer has to pay more. And if an American consumer has to pay more, it means there is massive inflation. It's going to result in destruction of buying power. So demand gets destroyed. And ultimately, it also results in a slowdown in the economy, which results in a slowdown in demand for many of the IT companies. So IT companies, remember, are significantly dependent on US companies. And if they experience slowdown, there will be, of course, a lot of pain sharing, which will result in potential reduction in volume growth. And hence, we think that there could be some challenges for the IT sector going forward. So we have reduced our expectations over there.
Okay. Okay, so a comprehensive conversation. Thanks so much for joining in. And to the point that you made initially, I think I will reinforce that as we're leaving, or as you're leaving us, which is to broaden your horizons and extend your timelines. So thanks so much for joining us. Pleasure speaking with you.
Thank you, Alex. Thank you.